This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Thanks for joining the show. Today we're going to talk about a 9% guaranteed money investment opportunity. Now, here's the question. Is that fact or is that fiction? And we'll talk to Andy and see what he thinks. Before Andy jumps on, though, please hit the like. Please leave us some comments. And by the way, those stupid bots that are out there talking about some people who are the greatest coach ever, and then there's 37 bots under that bot. If you're leaving a comment, I don't know, just tell them to screw themselves or something. I don't know.
My gosh.
Super irritating, and it's not appreciated. Sorry, Andy, I'm going to go off a little.
I don't know. I take it as a compliment if they think that they can ride these coattails. That's.
I think it's insulting to the audience, is what I think, because they're going to fall for this. But two, they're making a mockery out of the comments. Like when we're trying to read the comments and trying to find what people really want and stuff, and it's super frustrating. But so, anyways, I'll stop. Who cares, right? Who cares, right? This is not financial advice.
Thank you on this one with a headline like that.
I do want to be especially careful. So this is for education only. Okay. So Andy, I have before talked to you about guarantees and no risk, and every time, Andy, every time you bash me down. You say there's risk management, but there's no such thing as no risk. Even when I write things, you cannot use the word guarantee. And you're pretty much the sledgehammer on this. And yet, to the audience, Andy came to me with the word guarantee. So I'm gonna blame you for this, Andy.
Boy.
So then I have to push back and say, Andy,
I can't believe I said that.
That's fiction. And Andy said, well, maybe it is, but it might be a fact. Well, so let's hear this, Andy.
We're gonna delve into this, and we'll talk about what the guarantee really means and how this came about. One of the people on my team, key instructor for us, his name is Corey Halliday, and he took a traditional route. He got in the United States, we have something called a Series 7 license, lets you be a broker and make money by, helping people buy. It's like a real estate agent. You get a commission off people buying and selling, working at a broker. Then he got what's called a Series 4, and he became the head of option trading at his firm. He worked for a Wall Street firm, managed the risk of a floor of traders, hundreds of traders, and managed the risk for the firm. So he's our risk guy. And when I worry about risk, I go to him, and he said, hey, Andy, have you seen the, and I can't believe I didn't pay attention to this, but he says, have you seen the yield on the I bonds pop with the CPI? I says, it really would, wouldn't it? And so I don't buy bonds. I'm not a big bond guy. I have some bonds as we speak, but usually bonds don't yield like what a stock would or what a real estate investment would. So a bond is what we'll be talking about today, and we'll be talking about an I bond specifically.
So first of all, bonds are so boring. So I'm curious how you're going to make this exciting.
Well, not necessarily. They can be interesting and they can be complicated. What made me want to reach out to you to this, though, is as I was looking at the investment for myself and my kids and my wife, I thought, my dad might be a candidate for this. So I went over, and my dad's in his 80s. He's just a great sage, and he's the type of guy, his uncle was a World War II vet, and he's the type of guy that'd get a bunch of $1 bills, put a rubber band around him, and hide them somewhere in the backyard, that type of thing. And so he had a little bit of cash. I said, Dad, you've lost 9% of your money, right? And he says, what do you mean? I said, well, if you just hold this under your mattress or at your neighbor's house or wherever you hide it, its spending power is 9% down. Try to take that same amount of money and buy gas with it now and see how far it goes. It's almost like if you're an employee, what has happened, imagine every employee going into their office and their boss calls them and says, hey, times are tough. We're going to knock your pay 10%. So instead of making, $50,000 a year, you're going to make 45. Or instead of making $100,000 a year, you're going to make 90. That's a pinch for a lot of people. And that's what 10% inflation does, is it takes your savings. What if the savings people called you and said, hey, you know that $100,000 you got in the bank? It's 90 now. I mean, that's how inflation steals. So as the government prints money, they steal. So one of the things that the government has is there's several types of government bonds. So I've taught my sons this way. I start with the lowest common denominator on bonds, which I say probably the most brutal bond business is the bail bond business.
Okay, that's fair.
I go, if you're in the part of town where it says bail bonds everywhere, you know to make a left and get out of that part of town. And so really when someone can't make bail, they borrow the money. So a bond is a loan. And they borrow the money at an insane interest rate. We have things called junk bonds, high yield bonds. The less chance it is to be paid back, the higher the interest. So if you're a bondsman, a bail bondsman, you're dealing with people that are a risky deal because they've been accused of a crime, and some of them have been innocent until proven guilty. Some of them just a matter of time before we only caught one of the things they did wrong, right? And so the more risk you have, the higher rate you get. And that's generally the rule.
Right.
Hi, this is Andy Tanner from the Rich Dad StockCast and founder of the Cashflow Academy. If you're enjoying what we're teaching here, then I think you'll also really enjoy a special on-demand web class I've created for you called How to Cashflow Stocks. I'm giving this free training to you because it's never been more important to enhance your financial education. Hey, who knows where the market will be next week or next year? For me and my team, we really don't care because we use strategies that will give us protection and cash flow no matter what is happening in the market. So if these are the kind of investing strategies you'd like to learn for yourself, go to StockCastBonus.com now and get this training at no cost. You can access this free training right now at StockCastBonus.com. So head on over to StockCastBonus.com now, and I'll see you on the inside. There's something called a Sharpe ratio. I don't want to get too jargony, but that's what we're here for, is to learn education. The Sharpe ratio tells me how much reward am I getting in terms of the risk that I'm taking. So someone might say, yeah, man, I'm getting 5% on this thing. And I'm like, well, you should be getting 50 compared to the risk you're taking on it. It helps us know whether the return we get, it justifies the risk we take. So the standard in the world is a U.S. government bond. And the reason we use the word guarantee there, and I hate it, they call them risk-free, and I hate that. Guaranteed and risk-free are not the same. Guaranteed means that you will get your money for sure because the people that have the printing press are borrowing the money from you. And if they don't have any, they'll hit the keystroke, print the money and say, here's your money. So the word guaranteed absolutely is valid in that you will get that money back. Now, what's not guaranteed is the value of the currency itself. So they call it a risk-free investment. I have a hard time with the idea of risk-free because you're dealing in dollars that might lose. So anyway.
But real quick though, U.S. Treasury bonds are considered around the world as the safest investment there is. Is that accurate?
By and large, yes. That you could make that argument that is the world reserve currency. It's certainly in demand. And they certainly have the power to print them, and they're used. And so, yeah, a lot of people feel very safe. I would say this, there's not very many people in the world that believe that if they loan the government money that they wouldn't get paid back, right?
Our government, the U.S. government. Yeah.
I mean, we live in the U.S.
Yeah.
Right.
So the whole world, even whole nations
Japan,
buy these bonds.
Well, look at all the bonds that China buys, and look at all the bonds that, people buy bonds around the world from the U.S. Now, here's the thing. There are treasury bonds, treasury bills, treasury notes, though all of those loans have to do with the duration of time. So we'll set those aside and we'll put those, and there's something called TIPS, which adjusts for inflation. We're going to put all those in a basket called marketable securities. And what a market, this is very, very much, this is less like a podcast, more like a class, I feel. I hope I'm not lecturing too much.
No,
I'm used to being with Robert where I have the people in the room do the talking. So the way this works is you have a you have these marketable securities where if I buy a bond, loan the government money, I can sell that to someone else, just like your mortgage could be sold in a CDO or whatever, right? You have the ability to market these. And there's something called the bond market. It's bigger than the stock market, smaller than the Forex market, larger than the stock market, but it's a huge market where these bonds go. Now, the interest of these can change. Let's say you go out and you buy a bond that pays 2%. And then all of a sudden, the next month, the government comes out with a bond that only pays 1%. Which bond is more valuable, the one that pays 2 or the one that pays 1?
Right, you want the 2. Is that a guaranteed percent? They can't. It's not adjustable.
That's right. It's guaranteed. It's locked in unless it's a TIPS. It's locked in. So if all of a sudden you buy a bond that pays 1%, and all of a sudden they come out with a bond that pays 2%, your bond is worth less. So weird. Interest rate goes up, your bond value goes down. Isn't that weird? And the opposite is true. If you have one at 2%, and then the government says, we're not offering 2% anymore, we're only offering 1%. Since you have that 2% bond, you get a brag. You say, hey, I'll sell mine to you. Mine's 2%. So they'll pay more for yours than they will for the other one, simply because it's paying a higher yield, a higher rate of return. So here's what's interesting. There's non-marketable bonds, and these are called U.S. savings bonds, and they come in 2 basic types. One of them just pays a flat rate, and it's fixed, and it's usually pretty low. And the reason people do it is it's a safe place to put money. The other one that's a very interesting one is the one we're going to talk about here is called an I bond. And you can't get these at a bank. You can't get these at a brokerage. You can't get them from a dealer anywhere, and you can't sell them. They're not marketable. You can't get rid of them. You have to deal only with the U.S. government directly. And they have a website. If you want to put a link in, it's called Treasury Direct. There's a lot of education on there. It's not the most, it's a government website. It's not like the cleanest, best, you can tell it's a government website, but it's called treasurydirect.gov. And this is where you can work directly with the Treasury Direct, right? And what an I bond does is it resets an interest rate. It's a variable rate bond. And it resets every 6 months. I think it's May and October that it resets, I think. And what they do is they look at the inflation rate from the CPI, the core price index, and they say, hey, how are we doing inflation wise? And they take that and they adjust the rate to keep up with inflation. So this is actually bad news. People get excited about it, but the rate they will pay until, I think it's till October 22nd is when they'll reset this, is 9.62%, I believe. Double check me on that, but that's been the rate of inflation.
So wait, once they set it for 6 months, then it's fixed.
It stays for 6 months.
Okay.
That's what you get for 6 months.
So I would say I got to ask one more question just to make this make sense. When you buy these I bonds, can you buy them for only 6 months at a time?
You got to buy them longer than that. And that's kind of the caveat to this. Okay. So, and they could change the rules. That's why I don't like talking about this stuff, because rules change and things change. And all of a sudden someone says, Andy said this is not that way anymore. Right. So I'm going to disclaim again saying, do your research, talk to your advisors, say, hey, the best thing you can do is say, hey, I heard about these I bonds, but really learn about bonds. Here's a great axiom. Don't invest in things you don't understand. How about that? People go to an advisor and they do it all the time. They have my advisor understands it. Well, I'm a rich dad advisor. I'm not your advisor, right? I'm Robert's advisor. So don't take my advice. Don't invest in things you don't understand. So learn about bonds before you buy bonds. Learn about stocks before you buy stocks. Learn about real estate before you buy real estate. I love how Robert Kiyosaki answers these questions. I see it all the time. They say, Robert, do you think real estate's a good investment right now? And he says, what do you know about real estate? The guy says, not very much. He goes, stay out. It's probably not a good one for you. Someone, hey, where do you think real estate's going to go? What do you know about real estate? I know a lot. I've got, 50 houses already in, 4 apartment buildings. Oh, it's probably a good investment for you. It's always a function of the investor, not a function of investment. So
can I add to that real quick?
Please.
When you do that, you have to keep your ego in check, because I once saw Robert, who, greatest real estate investor I know.
Yeah.
And he brought the team in to hear what this one guy was pitching, so we could learn through the pitching and things like that. And at the end of it, Robert, the most intelligent real estate investor I know, says, "You know what? I don't get it, so I'm not in." And we were all just like, "What?" But it was impressive that he checked his own ego. And the thing that everyone looks to him for, he still said, "I'm out. I don't get it." Well, I just thought it was really cool.
What I think is cool about that is there was no greed there, because a lot of people are so worried about the result, and they feel like, well, I'm missing out on money. I'm missing out on money. I'm missing out on an opportunity. I don't know anything about it, but I don't want to miss out on the money. And they let those emotions drive them. So while we're going to talk about this 9% return, and it's absolutely there and it is guaranteed, right? My message would be, don't invest in things you don't understand. And this is not going to make you rich. Okay. That's really important to understand. This I bond is not going to make you rich. It is not. It is a savings bond. So people hear 9%, they think they're getting rich. All they're trying to do is keep you even. Right. A savings bond is designed to be a place to save your money that is less risky. Like if you put money in a safe, you have a theft risk, you have a fire risk, you have a risk of loss that way, right? And you also have inflation risk. So saving money when you're printing this much is, so the government says, look, here's a place where $1 can still be $1 in a year, because we'll pay you what you're losing because of inflation. So this idea that, 9%, this is awesome, I'm getting ahead. No, you're not. You're just trying to tread water and stay even. You're not getting ahead. But as I went over to my dad and I said, Dad, maybe you ought to learn about these. Let me teach you a little bit about them. If you want to talk to your advisor or whoever that is, talk to them if you have one. But I will show you what these are, and then you can make your own choice. And I explained that in his, if he keeps it in a safe or under a mattress or in his neighbor's, wherever, secret place or whatever it is, that's losing purchasing power. And you've lost 9% already. So you can invest in a bond with the U.S. government. It's called an I bond. It's not marketable. You can't transfer it to anybody else. You can't put it out there on the market for sale. It's between you and the government. So here's some rules, and there's some risks here. Number one, you're going to lose liquidity for a year. They say, look, we're not going to have this less than a year, so you can't touch it. If you ask for it before a year, they'll say, nope, it's not the agreement. Can't have your money back. So again, this is to save money, not a checking account. If you need access to your money within a year, this is not an investment that is a smart one.
So you suddenly get the world's greatest deal right in front of you. Boom, you got to buy this real estate. You have enough money, and then you're like, I can't. I'm going to have to pass the opportunity because you can't get your money back.
Well, now you could. I would imagine someone would allow you to use that as collateral. Right.
Okay.
You have collateral. It's pretty, safe as collateral. People that have money markets that can't afford to break the buck. If you have a money market and someone gives you $1 to go trade stock with, to have in their stock account, well, you can't have less than $1 tomorrow. And usually those guys invest in government securities or commercial paper that's very, very low risk. So you're in for a year. Okay. Number two, if you want to pull out within 5 years, okay, year between the end of year 1 and year 5, they're going to take the last 3 months of interest away from you as a penalty. So ideally, this is a 5-year investment or longer. Okay, 5-year longer. They will continue to pay on this bond for a period of 30 years. After 30 years, if you don't cash it in, they won't pay you any more on it. So it has a 30-year maximum.
So when you buy it, do you set your maximum at that point, or after 5 years, you can just re-up?
You just buy it, and it's up to you after that. You're in for a year because they won't give it back to you. After 5, you can weigh it. You can say, well, is it worth giving up the last 3 months of interest? Another cool thing is they compound automatically. If you let's say buy $1,000 bond, it pays you $90, $96.20 is what it pay you. So you buy your $1,000 bond, and at the end of cut that in half after 6 months, that'd be $45 and whatever it is. They take that interest and they kind of put it right back into the bond, and they kind of make your bond bigger. So it's compounded semi-annually.
Oh, that's cool.
Yeah. So whatever it is, even if you get a paper one, some people like really want to have the paper one. This is bizarre. My dad is that way. He's like, well, can I get the piece of paper that says that bond? I said, well, you can, but the way you do that is through your tax return. Is you say, instead of giving my tax return in a check of cash, you can send me a bond certificate instead. So they can either send you a check from the Treasury or a Treasury bond. Either way, they're happy to, but that's how you get a certificate. And even if it grows, they will keep track of that, and the interest will accrue. And if you go to cash it in, they'll do the math. After 5 years, there's no penalty. You can say, I want out, you'll keep everything. So a year, they won't give it to you. After a year, between 1 and 5, after that first year, 3-month penalty. It resets every 6 months. So if the inflation rate were to drop, then the interest would drop. So you're basically trying to keep even. So when people hear 9%, they get all excited. And yeah, they'll pay you your 9.62% right now until October. If we have more inflation, that rate will go up in October. If you have less inflation, that rate will go down. So it truly is not, you don't get rich by saving money. You don't get rich by saving money. Saving money is to have a place to put it that is safe. That's all it is. This is designed to be that with some inflation protection. So this is not a wealth grower. People are, well, 9%, I'll compound this and figure that. It's going to be variable. And so while you get all excited about 9%, realize, well, you lost 9% over your last 6 months anyway. This is just a way to get it back
right.
in the next 6 months.
Can it go, let's say you put $100 in, it can't go below 100.
It will not go below that. If you put, and what's interesting is, you know what the minimum is? It's $25.
Oh, that's cool.
I think, don't hold me to that. I put in more than 25, but I think now there's a maximum of 10,000. You can't do more than that. And that's, that makes like a non-marketable security, this is designed for individuals. It's an individual savings bond. Okay. It's not designed to be marketed and traded. It's to give. And I thought this is the only reason I said my dad, you might consider this and ask whoever you work with about it. As I said, if I know you're saving cash, there's a liability of theft. In LA, they have these follow home guys, and so if someone thinks you have money, that's not good. And a lot of older folks will save cash. I go, you don't want cash in your house. It's not doing you any good. You're not using it, right? So get it out of the house. Number 2, you're losing buying power tremendously, Dad. And as I see inflation hit, I at least want him to keep, where he's at and tread water. If your plan was to tread water anyway, well, great. Don't get sunk by inflation. At least keep pace with it somewhat. And so whatever the consumer price index, I call it core. I meant to say consumer price index, which is stupid because it pulls out gas and food, I believe. The Fed doesn't even use that one. The Fed uses, now I've spaced my stuff. It's a consumption, PCE, personal consumption expenditures, I believe it is. What they actually do spend the money on. But either way, it's in the ballpark, and it's an interesting investment. So you can do 10,000 for you, 10,000 for your wife, 10,000 for each of your kids once a year. That's the max they'll let you do. Isn't that interesting? The government will only let you save that much and protect that much of your money against inflation. I like it for what I like. Like, I'm the same way. I think that you want to have, like, I look at savings for a rainy day if I needed cash emergency. So this isn't something that I would, put $1 million in over, 100 years.
Right.
It would be, it's a place to store cash, but it's not an investment a lot of people know about. When people ask me about it, they're like, really? That's there? So you can read more about, there's actually some decent education on their website. You can learn about what a T-bill and a T-bond is, right? T-notes. TIPS, TIPS, those are marketable bonds that adjust with inflation, but they're not nearly as aggressive in the adjustment as the personal ones are. So right now it's at 9.6%. That'll be good till October. If we continue to have inflation, they'll raise that or maintain it. If the inflation drops, the rate of return will drop, but you're in for a year.
So we called it an investment a couple times here. Would you just call it a hedge to be realistic?
No, I mean, what does investing mean? I mean, if you define it as wanting to get a return, well, it is giving you a return of more than you put in. Now, so I don't think you invest or hedge. You say, is this investment a hedge? Yeah, it's both. It's an investment that is a hedge, might be a way to. I think I'll invest to hedge against inflation right here. But I'm certainly not buying a business. I'm not providing any service other than helping the US government, right? I'm helping them with the money they need. And boy, do they need money. So they're willing to pay me a lot if I'll lock it up for a year and obey by those rules. So it is an interesting investment. I think it's important to know about it because let's say someone doesn't have any financial education. I believe in trying to strive for passive income above your expenses. I believe in cash flow and that type of stuff. So the stuff we teach is much more aggressive. And if you're Robert Kiyosaki and you have the cash flow game, you have the rat race and then the fast track. Fast track investments are for accredited investors only. They are for insiders. They are the stuff that comes across my desk would never come across the desks of non-accredited investors, right? They don't get to play that game. And it's kind of silly because it's based on, you either got to have, like $1 million liquid other than your house to be a credit investor, or you have to, I think you got to make like $300,000 a year between you and your wife, whatever those parameters are. It's not an education premise. So let's say someone's not an accredited investor. They don't know real estate. But maybe it's grandma who is storing her money in cash. Well, if we can help her by educating her on a place to keep that where inflation is still brutal, but it doesn't hurt her as bad. It's not investment get rich, but it's one that people might look into, ask your accountant, your financial advisor about, and see, and they can expand more on beyond what I have. Those basic rules: 10,000 max, 25 minimum. You can even set up a schedule. Like everyone will do this. You can set up an auto pay where you buy bonds on a regular basis. But please understand, think of this as what it truly is: saving money. Is it an investment? It's an investment in the U.S. government. Are you saving money doing this? Well, you save money, keep it, hold it, whatever. I think I'd rather invest my money other places myself. But $10,000 to stow away for someone, okay, great.
Yeah, it really depends on your mindset and your financial education. If you don't have a lot of education, this might be where you want to keep your cash.
You and I will look at some of the trades that we make in options, and certainly, I'm aware of one of the trades you made recently. Certainly, that yielded far beyond 9%.
I don't want to brag, but we're looking at 20% right now. I'm not trying to brag here.
Don't brag, but we'll have some we lose in someday too. But
hey, no.
But the fact of the matter is that those are available. So I thought it'd be a fun podcast simply because people, if it does, what I would hope it would do is start a financial education journey. Because if someone says, okay, here's 9%, backed by the federal government for the next 6 months, and it could continue it will continue if inflation continues. Wow, that's interesting. But my hope is that they don't get fixated on the investment, that they say, you know what? I didn't know about this. What else don't I know about? What else? What other options are out there for me? No pun actually the pun wasn't.
Yeah, it did feel a little.
Yeah. What other things are about? And I hope they read about bonds, say, this is actually interesting. What are the differences? Well, this has this time. What about it? What's a yield curve? What's that have to do with things? Why Why is it an inverse relationship between when the rates fall, the bonds that were already out there get more valuable all of a sudden? Why is that? To start to learn would be if this was a gateway drug to learning, that would be a successful podcast to where people say, wow, there are stuff out there I did not even know about. I want to learn the context around it.
And to me, it was a little bit different learning. It was actually much more factual on what inflation is doing, how high it really is.
I'm just proud that I hypnotized you, because usually you've done a commercial break by now. Yeah, finally, you're so good at it. Usually you're right up to the point. Are they really guaranteed? Hi, this is Andy Tanner from the Rich Dad StockCast and founder of the Cashflow Academy. If you're enjoying what we're teaching here, then I think you'll also really enjoy a special on-demand web class I've created for you called How to Cashflow Stocks. I'm giving this free training to you because it's never been more important to enhance your financial education. Hey, who knows where the market will be next week or next year? For me and my team, we really don't care, because we use strategies that will give us protection and cash flow no matter what is happening in the market. So if these are the kind of investing strategies you'd like to learn for yourself, go to StockCastBonus.com now and get this training at no cost. You can access this free training right now at StockCastBonus.com. So head on over to StockCastBonus.com now, and I'll see you on the inside.
All right. Thanks for joining us back. And we did promise you a free gift. It's not a 9%, 10% hedge investment, but what it is something that can never be taken away from you, actually, which is really cool. Wow. This gift is from Andy Tanner, and it's called knowledge. And it's not just the knowledge that we hear on the show, but one of the things Robert always says is they can take your money, they can take your house, but you can always rebuild, because they can't take away your knowledge. And so in that vein, Andy has given us 3 or 4 webinars he's done in the past that you can go to the show notes, click on the link, and then you can listen to some of his past teachings, and they're really great. And if I could just 2 I really love. Zero to Cash Flow is incredible to me.
Yeah.
And then there's another one which is really important right now, and that's investing in a crisis, which obviously, nails it. So I do want to recommend both of those, if I may, Andy.
I'm so excited for the future. I know that there's a lot of volatility out there. There's a huge amount of problems, but the thing is, problems do nothing but create opportunities. And when we look at it through that vein, education is that's where the value's at. So that's why I've been an education advocate for many, many years for financial education. And that's why I love and appreciate you, Greg, for getting together every week to get a chance to share what little I've learned so far about money and finance.
You're not just an advocate, you teach it. I've read some of the testimonials. You know what we should do? We should have a whole show where we read them, because you will be crying the whole time. It will be, you will cry so hard, it'll be hilarious.
What's funny is people say, I don't know that I'm a humble person. People say, Andy, how do you stay? I had a guy ask me once, he goes, how do you stay humble? I go, well, number one, I don't know that I have, but I will say this, I feel humble, because now I'll get emotional, because I have so many blessings, and to think that, I didn't become a teacher because I was a better investor than Warren Buffett was, obviously. I became a teacher because I had a knack, people say, of making stuff simple, and I care. And those two things, having someone that cares about you, makes it simple, has been valuable to people. And the fact folks around the world have been willing to listen to what little Andy would have to say, it is humbling. It is. But it's also exciting, because there's a switch that happens in people. It happened for me when I read Rich Dad Poor Dad, and that happened again when I played the cash flow game. When they play the cash flow game or read Rich Dad Poor Dad, there's a flip where all of a sudden, instead of education being a burden that I have to do to get what I want, it's this insane excitement of discovery, and oh my gosh, and things click and the world starts making more sense. And I think life, I don't know if it gets easier, we all struggle, but it becomes more doable, I think. So that'd be my bigger message than if learning about an I bond and going in there and saying, okay, Andy said, don't invest in things I don't understand. I'm going to study this a little more. If that gets people going as a gateway drug to learning more, I'll take it every time.
That's fair enough, Andy.
All right,
thank you very much for the show.
Thank you. We'll see you.
All right. Thanks, brother.